Good morning, traders. It is Wednesday, June 4th. Early video today. I'm off to Ultimate Frisbee tournament with my daughter and want to just get this still out. Just a quick update. Not a whole lot has changed. Everything has been unfolding as expected. In the grand scheme of the markets, when we take a look, we were expecting the market to put in a significant high. We ended up having a trend reversal. We had that huge panic washout low, and then we were looking for a big dead cat bounce. We have a massive dead cat bounce. I should mention the dead cat bounce that happened in the NASDAQ in 2000 after it put in a top. It sold down like 44% and then rallied 64% up to near its highs and then rolled over. So dead cat bounce, you can call it a dead cat bounce, you call it a bear market rally. Either way, it's still an uptrend, and it is a bounce within a downtrend. And we are still technically in that theory that I believe that the market is trying to put in a top. It has potential to poke and push into a nominal new high again. Obviously, it could always do that. But to me, we have had that breakdown, and this still is a bounce, and we could very easily roll over and go lower. It doesn't really matter. Again, we're just following our strategy. When we take a look at the strategy, we avoid. The whole point of our strategy is to identify when the waves, the big sets of waves that roll through the markets, when they lose momentum, which was here. And then we can avoid and move into positions that continue to grow our account as the market goes into this chaos. And then we can also tell when the wave is picked back up. We can jump on that wave, that set, and ride it higher, which we've hit some targets. And now we're breaking out of this bull flag pattern, pointing to this market moving higher. We're close to hitting our 10% target on the QQQ. And we're getting closer to our SPY target as well, another target on the SPY. When we take a look at the chart on the right, we haven't looked at this in a while. This is our sentiment chart. This is telling us what money flow is doing, what investors are doing based on a lot of different pieces of data. And deep red means like there's blood on the streets. Money is flowing out left, right, and center. We don't want to be holding it, and the market goes down typically. In an uptrend, we usually want greens. Dark green is very strong. Typically within an uptrend, when we have these little pauses of orange, those are usually short-term fakeouts and shakeouts in the market. Usually we have green panic selling and oversold market conditions, which are over here on our charts here. It tells us on our 30-minute chart when we're oversold, when we have panic selling. And then, of course, we also can gauge the overall trend and FOMO on the markets here. So there is no real big surprise. Again, we're just riding this trend higher, following our analysis. No matter what we think or do, or no matter what we think and feel, we don't take action on those. We actually follow price. And a lot of times when there is a trade setup and it is very difficult to want to get in, this was one of those trades. We have a major resistance area right through here. The market shows lots of volatility. Things were looking pretty bearish, but from a money flow standpoint, money was actually moving into the markets, and most people thought the market was going to go down again here, which I thought we were going to see that. Instead, the market hooked up and it said, hey, this is a swell. This is a nice wave going through, and we got long. And typically, the hardest trades to get in are the ones that work out, and that is, same with getting out of trades. The trades you don't want to get out of, there is a point where you do need to get out and protect your capital, especially when the tide has changed and the swell is about to curl and break. You got to get out of that in the markets. Let's take a look at where money is flowing today. So equities are moving higher. Bonds are moving down a little bit. We can see bonds continuing to struggle. I think there's potential for it to continue to move down. We did have that short-term overbought territory yesterday, which is the shaded red area, telling us that bonds are probably going to get sold and move lower, which they are. If we take a look at let's just pull up the NASDAQ real quick. We'll pull up the 10-minute chart. You can see here the price action that we have seen. We had this big move up last week, and then by the time the markets opened, it came down and gave back some of that. But we have seen a flush out last week a bit, and now we're starting to see the market recover. So we've got this nice push and a pullback, a push and a pause. It is setting up for another push higher, and we could see a significant rally over the next session or two in the equities markets. And this could pull Bitcoin up with it. Bitcoin moves generally with the NASDAQ now. 9 out of 10 days roughly. It has pulled back. It has a bullish pattern. It's had a series of bull flags. And we could see this start to move. You can see this oversold indicator as well, telling us that Bitcoin, hey, it's not only oversold, it's tagged the 20-day. It's got a nice little bounce, a little intraday bull flag pointing to higher pricing. And we'll see if it hooks up and starts to move higher from there. Looking at gold, gold had a little bit of a pullback yesterday. It is holding tight here above this 5-day moving average. It has this big bull flag pattern. It is primed and ready to pop and break and have another move to the upside. 37.50 somewhere in there, or even higher. It has potential to keep going. The monthly chart of gold, as we've talked about many times, is in a full-on bull market phase. It is in that blow-off, I believe, kind of icing on the cake. It can give back this very quickly, but you do not want to bet against it. And there's still a lot of chaos and uncertainty in the market. And if the stock market struggles for several weeks or another month or so, this could have another bar or so where it pushes up and continues to go deeper into this, deeper into higher pricing territory before potentially having a bigger pause or pullback. But definitely it is in one of these parabolic moves, very similar to what we saw over here and over here and over here. And over here, percentage-wise, it is the same just before we go into a big pullback or a multi-year pause or correction. So I do believe we're getting close, but again, it is still in an uptrend, and we don't fight the trend. You don't want to bet against something that is moving higher. Silver is similar. Gold miners, let's take a look at GDX or GDXJ, doesn't matter, same thing. They're already breaking out, and so we're finally starting to see miners outperform gold, which is actually a fairly bullish sign. Haven't seen that really too much in the last several years, so this is an interesting play here. I think it's telling us we need to be aware that when gold is performing very well and miners are coming to life a bit, typically it means we're very close to an economic, financial type of reset. As money's moving to these, no matter what. Instead of people moving just to the ARK ETFs and the aggressive other small cap stocks, they're moving into gold and gold miners as a defensive play. And that is a bullish sign for gold to still move higher, and also that we're coming to, I think, a financial reset in the financial system and a big correction at some point. That's why money is trying to get protected into these type of stocks and plays. If we take a quick look at crude oil, again, nothing too exciting here. We've got price stuck under this 65, 66 area, which if we zoom way back on the charts, you can see it's a very significant point. We are underneath that with what is, you could look back and say this is a pause before going lower. It has had a nice move over the past couple of days, but really it's just back up to short-term resistance. It has, some mixed signals. Obviously, it has a little bit of a double bottom, it has a little bit of a bull flag. It is trying to push up into this area, and it might want to push up into 66, maybe 67, 68. Either way, it is a series of lower highs, and it is still more or less in a downtrend no matter what. Now, if we take a look at the short-term price action, you can see we went from red bars to orange bars, and oil has had a bit of a pause and pullback. It's shifting from a downtrend to a neutral trend, and now we've got this oversold market condition, and of course it's had a nice pop from that. And again, this 30-minute chart is a momentum trading. This is very short-term stuff, but it's telling us short-term the trend has moved positive, and it within this little base, and I think we're going to see it want to push and go a little bit higher still. But in the grand scheme of things, I do think any pop or rally up into this area is going to get sold down at this point. So just be aware of that. Last but not least, some of you have been talking about how you've heard me talk about dividend stocks and how dangerous they are and how they're not nearly as good as advisors in the financial system make them sound. This is the SPYD. So this is on average, this is the dividend. If you hold a basket or ETFs for dividends, this is more or less what your portfolio would look like. I think the biggest thing for people to understand, I've gone over this many, many times, I've written articles on it, videos. The COVID crash, you lost almost 50% of your life savings right when you need it the most. And since then, in 5 years, it's only netted 6%. Now, it does pay dividends, but it's fractionally, it's nothing that significant. But everybody's sold on the dividends and that they're big, strong companies and that they'll always be around. And while they may always be around, when all the investors, which there's the majority of the money, all the retirees with the most money are panic out of the same stocks, they get hit the most. So you have a huge downside risk and you have very limited upside over the past 5 years. If we were to just flip this scenario and look at the SPY, here's the SPY for the exact same time frame, the same high of the dividends. Obviously, much lower risk, only 34% drawdown that you had to suffer, and 79% upside plus the dividends, which aren't added into that. So you can see the difference. Dividend stocks, drip, dividend reinvesting, buy and hold strategy, they are all very, very dangerous. I always call them the ticking time bomb for retirees. They're great if you're 20 years old. If you're 20 years old, I think you're better to go into riskier stuff than the buy and hold and all that stuff. But the buy and hold in dividend stocks is super dangerous. When we go into a financial reset, it is going to destroy millions of people's retirements. And it just sounds good from an advisor standpoint, and it's just what the financial system brainwashes everybody to do. It makes sense in theory, but as we know, theory doesn't always match reality in the real world. If you're an inventor and into science and all that stuff, we all have theses and theories of what sounds good, what we think is going to happen, but in reality, it just doesn't work. And that is kind of our whole strategy with asset reinvesting, is just follow price. It doesn't matter what happens or what the news is. The reason when price rolls over, we get in, we get out, we manage positions, and that's how we've done the same thing with the NASDAQ trade, with the S&P 500 trade, very similar trade setups, both a little bit different types of groups of stocks. Sometimes we have one perform much better than the other, and that's just how we go about navigating the markets. Anyways, that's it for now. Talk to you soon. Bye-bye.